Okay, awesome. So I have Jerrett Morris here with Thrive Mortgage. He's been doing this for over 20 years. Jerrett, if you want to introduce yourself, he's a great business partner of mine and helped me a lot and my clients a lot.
Sure. Well, thanks, Chris. I appreciate the opportunity to be on this call and this kind of Zoom presentation. My name is Jerrett Morris. Most folks call me JMO, and I like to tell folks I'm the chief peace of mind officer in a mortgage transaction. It's my job to help folks kind of navigate the waters of what can be something that pushes people outside their comfort zone in a huge way. And so I don't get paid just to talk about rates or putting a loan together. It's really to deliver peace of mind. And that's what I'm hopeful we can do in this phone call is share information that will help everyone that hears this increase their peace of mind.
Awesome. Well, I appreciate it, and I can attest he's helps give me a peace of mind and helps me through some difficult and interesting type situations we run into. So I'm just going to get right to it. This is going to be a market update of just kind of where we are here in 2022 going into 2023. And one thing I want to start with is a question that a lot of people don't necessarily ask, and there's a lot of misconceptions with. At a high level, can you explain how mortgage rates and what kind of affects them?
Yeah, absolutely. In my 20 years of doing this, that's a question I've answered a few times, and each time I do, I'm always reminded of how little we as American consumers know. There's a lot of stuff in American finance that's never taught, and mortgages are most certainly never ever brought up. And so there's just misconceptions about how a mortgage rate works. And so the first thing to note is there are 17 different factors that go into every single person's rate. So every once in a while, we'll get a call into the office and say, well, what's your rate today? And we don't have an answer for them because that would be like calling a doctor and saying, give me a prescription. Well, we need to look at the factors, like what are the 17 things that would go to kind of create that rate? And those things, I won't go through all of them, but like some of the big items are, what's the credit score? How much down payment? What's the debt to income ratios? What type of loan? FHA, conventional. And so all of these things kind of factor into what that rate will be. And so that's the easiest answer to kind of start with. But there's a bigger picture to that really is driven by how mortgages make money in the US, because everything comes back to the dollar, how people are making money. And so the mortgage industry is a multi-trillion-dollar machine as part of the overall real estate kind of sector in the US. And depending on who you talk to, it's between 20 and 25% of our entire GDP is attached to, real estate in some form or fashion. So it's a huge deal. And so mortgages, ultimately, at the end of the day, they are securitized and put into a block of mortgages in the millions of dollars and then sold on Wall Street as a security, as something that people can buy into, just like you would an index fund or any other kind of, stock, bond, you name it. And so that trading happens in what's called the bond market as opposed to the equities market. Equities is stocks and things like that. So the bond market, mortgages kind of live there. And that kind of behind the scenes machinery of how those mortgages are securitized and the powers that be are really what drive rates. So because people say, well, gosh, I saw the Fed raise the rate a quarter point, so did mortgage rates go up? And they are not the same. Those are two different animals. They do have an influence on each other, but they are not the same. And so at the end of the day, as an open market transaction, really driven by entities like Fannie Mae and Freddie Mac, and we won't get into too deep of who they are, but if you've heard those names, those are really kind of the drivers of what provide liquidity for these mortgages to be made for companies like me or Bank of America or Chase Wells or brokers, you name it. And so I've got some information kind of in the form of some charts that I'll kind of share because I think it's important to also see as we talk about rates, kind of both where we've come from historically and then also kind of how the mortgage-backed security piece of it works. So we'll kind of jump into that right now.
As you pull that up, like a thing that I just want to highlight that I think a lot of people, the most common misconception I get is how the federal rate is different than the mortgage rate. And I just kind of wanted to emphasize that they're not the exact same thing. They just affect each other.
They're not, and I won't take too much time on this, but since there's so much emphasis on what the Fed's doing to help combat inflation, for the most part, the simplest answer for where rates are right now is because of inflation. So the Fed's actions are designed to curb inflation and bring it back down. And in doing so, theoretically, as they move their interest rate higher and pull inflation back overall, mortgage rates should come back as well. So which is why I bring that up, is because it's counterintuitive. Some people say, well, I saw the Fed raise rates X amount, so mortgage rates must have gone up. Like, no, that's not how it went. And oftentimes it can be a relief. It could be something that could potentially bring them down. So I'm glad you brought that up for
Thanks for
clarification.
clarifying that.
Yep. All right, so this is just kind of a historical view of rates from when Freddie Mac started tracking it to kind of today. So we've got kind of the early 70s on this side, 4/2 of 71 to be exact, up through the most recent data that they just posted, which is 12/1. So it's about a week old. And so we can kind of see here that, like, you know, if anybody on the call is old enough and had a mortgage at that time, they would remember rates like that, or maybe they had a family member. And so they've kind of steadily fallen over time. And we were kind of in this kind of zone here where they're pretty good. And then throughout the pandemic, they were just ridiculously low because the federal government basically helped make sure that those rates were low to keep everything propped up. So now we're kind of starting to climb back up. So as a matter of perspective, people feel like rates are out of control, but when we look at it historically, we're still quite low. And so that is an important factor when a buyer is considering purchasing, whether they own a home and ready to move the next one or it's going to be their first one. Rates are still very, very good. And in general, rates have to top 10%. They have to top this line before, for most people, it makes less sense to purchase versus renting. So just a little side note kind of on the historical basis to this. But to round out our discussion on rates, because I don't want to take too much of our time together, but this next slide will kind of show what I was referring to earlier of like what really drives these rates. And while this may look like a chaotic mess, it's what's called the 5.5% mortgage-backed security, or the 5.5% coupon. And so just to kind of orient those who are watching, this kind of line of the red and the green and the red and the green, this is back, this graph starts May 13th of 2021. This is back when rates were in the low threes, kind of occasionally upper twos, and everybody was just happy campers. And then something that's important to note about this graph is it is inversely related to the direction that rates actually go, because this is the mortgage-backed security. This is what's driving it behind the scenes. So if you see this graph go down, that means that the interest rate that a consumer had went up. And so everybody's happy campers, was great. And then we started to see trouble. This is about 1 year ago. This is about November of 2021. Say, okay, great. And then we see it start to fall precipitously, and it just continued to go down and down and down. And it was June of this year that we had our first super major gut punch where the rates took a super steep dive up. They tried to recover because, again, like as this goes up, that means rates were going down, and then it fell again, and we tried, and then it just went into a really big free fall where rates just continued to go up, 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 up. And around this time, rates were at or near 8%. And so as we look to see how kind of things have ended up, because again, I think it's important just to kind of track things, this increase means that rates have started to go down. And I also want to bring this up too, because as we know, the media will oftentimes get it wrong and they'll say rates plummet. Well, rates have gone down, and we know this because this, again, is inverse, but we're still below where we were when the first major gut punch happened in June. So we've got some room to go for rates to improve. No one, not me, not anyone, can predict exactly what rates will do, and no one can promise you one thing or the other on rates, but we have a pretty good idea of where we think they'll head. And for any of the clients that we work with right now and have closed in the last 6 months, whatever rate we close them at, whatever loan product we close them at, we expect that there's going to be the opportunity for a refinance to save thousands and thousands of dollars when rates do hopefully go back down. And so I wanted to kind of put this chart in there because it does double duty. It kind of helps explain how things work, what's really driving rates, but it also kind of gives perspective and, quite frankly, hopefully hope to people that there's a light at the end of the tunnel that could really make things better when it comes to the rate.
Perfect. Thank you. So that being said, outside of rates, we kind of already started touching into this, but can you tell us a little bit about, what we've seen, rates and market like as a holistic, and where we sit today as a real estate market?
Yeah, so that's a great question. And so, in general, if someone has decent credit and they're getting just a regular 30-year mortgage, right now the national average is around 6.5 to 6.625%. And that is a really good number. When I got in this business, they had just dipped below 7%, and people lost their minds. They couldn't believe they could get a mortgage rate for 6 point something. So it's just really a matter of perspective that we got spoiled for so long with rates in this artificially low zone that a normal rate somewhere in the sixes, it just feels odd. So we're really kind of trying to change the narrative and educate people. And that's why I started with that one graph historically, so that we can kind of see in picture form like where we really are. And so we find ourselves at about 6.5%. And the other thing, and I want to bring up another kind of slide here because they go hand in hand, is we still very much have you know, a record low inventory level. And that is an important thing because it's going to have an impact for quite some time. And by some time, I mean years. We simply do not have enough homes on the market for sale or prospective homes for sale compared to the buyers that are out there. And so that is a factor that continues to be something we have to deal with. Thinking back to something we talked about just a few minutes ago, when rates kind of peaked at that kind of 8% mark, again, starting in June, and then kind of when they got to the 8% mark, that understandably gave a pause to the market. And everyone said, well, no, wait a minute, I don't know how I feel about this. I'm going to step on the sidelines for a second and see how this works out. And so we saw a lot of buyer activity kind of dry up and shrink. And so what we are telling every one of our clients and those that approach us is right now, like literally right now, is an excellent time to consider purchasing a home, because we do expect rates to get better. And as they do, that will just bring all those people that stayed on the sideline, they will come back into the market. And while it may not be as intense of a market situation as we saw, you know, the past, oh, I'll say kind of 18 months, where it was just really very aggressive from a competitive standpoint, it may not be that bad. It's certainly going to be more difficult than it is right now because, for the most part, sellers are more willing to entertain you know, negotiation discussions, as opposed to there were 50 offers on one home, and if you didn't offer everything in your firstborn child, they wouldn't even consider you. So right now is a really interesting time because buyers will have more leverage for these next probably couple of months than they will as we head into next year, because again, we expect rates to go down. It'll bring people back into the market. It'll be tougher. And again, we can fix the rate. The phrase that many people use is you marry the home, but you date the interest rate. We have lots of tools that we can help people kind of mitigate the interest rate factor, not the least of which a very likely refinance down the line to help save a lot of money. And so we're just really trying to encourage people to think about that, because the other factor, and Chris, I'll let you speak to this because this is more your world, we don't expect home prices to go down. And I've got some information later in our presentation, we'll go over that, but we may see the appreciation rate kind of level off, but that doesn't mean home prices are going down or will slip under kind of where they were.
And yeah, I think one thing I can definitely tell from my perspective of with the clients I'm working for on both the buy and sell side, with the higher interest rates and less buyers out there, I think my buyers right now probably have more leverage than they've had in at least the last 3 years when it comes to
Yes.
negotiating, if not longer.
100%.
And that's
that will change. It will change. It's going to change. And so that's why, for those folks who think, well, I'm going to wait, that's understandable. But if it's waiting because there's the perception that the market conditions will get better, they're not. Especially, and I know we'll have people who view this for across the country, and I can speak more specifically to the Texas market, but it's a basic supply and demand issue. And that kind of exists in most places in the US, where there's just too many buyers, not enough homes for sale. As we look at this graph here, we're currently about 870,000 available, but even that number is not as good as it's reported because a certain portion of those are under contract. So the actual number of homes for sale in the US is much less than that. And so this is, again, why it's a good time for buyers to consider now, is because there's not really going to be any more inventory coming online, and you have a better chance of actually negotiating on your own behalf with the help of an agent like you, Chris, than we will in the future. That's our expectation.
Absolutely. Thank you. So like I think that's a good kind of setup of how we got to where we are today, what kind of affected it. And so all of that saying, what does that mean for us now? So we are where we are. Are there any insights on what we can expect given that knowledge going into 2023?
Yeah, and that's a perfect segue for us to kind of talk about that. And so I've got some information on that too. And again, as if you haven't figured it out by now, I think it's always best when we try and project into the future and say, well, what are we looking at? We need to kind of look backwards as well to a certain degree, because if we don't learn from where we came from, it's going to be hard to know where we might be headed. So in this slide, I won't go through all the information, but there's a lot of concern of like, oh my gosh, is a home price crash coming? And this is sourced from the National Association of Realtors. They are the best in the world at understanding what is going on with the U.S. housing market. And so this column here, which says last housing cycle, what that really could be described as the last major kind of housing upset, which was the mortgage meltdown. It was what kind of was the predecessor to the Great Recession. It was that crazy real estate business that we saw that started kind of in 2004 and ran unchecked through 2007, 2008. And so that was a house of cards. That was built on the shakiest of foundations possible. It wasn't real. And so when we look at these things, oops, sorry, we shouldn't have gone that screen yet. Let's go back one. There we go. As we look at this, we can see there were some key things here, like back then, subprime loans, very prevalent. Now there's virtually none. It's very difficult to get that kind of a loan. There was a lot of people buying on a speculative basis because, as we all kind of joked, if you had a pulse, they gave you a mortgage. Like there was no criteria. So that's kind of out of the picture. The inventory on the market was a very different game back then. Now, as we saw on the previous slide, it's technically even less than this. The other thing too that comes up quite often is there's this persistent myth and kind of thought that there's this coming foreclosure wave. That's not going to happen. These numbers right here are when things were rough because there was a lot of poor lending decisions made. We are at a fraction of that, and the homes in foreclosure, the latest number that I heard verbally is even less than the 0.6%. So there is no massive flood of homes that's going to be released to the market in 2023 and beyond, which is also to say there's a record amount of equity in homes right now. And so whereas before, because this was built on a house of cards, there were countless people who were upside down. Even people in trouble on their mortgage, they're not upside down, so they don't have to let it go to foreclosure. They could sell and still walk away with some money. So I bring that up just because I want to give some perspective of the last thing that people tend to remember versus where we're headed. So before I get to the next slide, Chris, was there anything you wanted to add?
Yeah, just a couple things. One, just to reiterate, like the foreclosure aspect, because I get a lot of people that ask about the foreclosure aspect. And one, given the appreciation over the last couple of years we've seen prevents that, in addition with the not having subprime loans. And then on top of that, a lot of these people that are selling today, because the inventory shortage actually affects that also, where since there's such an inventory shortage, that these sellers are able to sell the property for market value. It's not like there's a surplus of inventory that, they have to go low below market. So even the people buying the foreclosures that exist aren't necessarily getting some super deal on it because there's not a big inventory.
Yeah. Yeah, it's interesting. And we look at the demographics of boomers to Gen X to millennials to Gen Z. It's ever shifting, and boomers become a smaller and smaller kind of powerhouse as far as their buying segment. And then we've got Gen Z that's coming up and will be the largest. But one thing that's interesting that's kind of part and parcel of all this is, at least within the boomers, there's going to be a record amount of wealth transfer. The biggest wealth transfer in human history is going to continue to happen as boomers age. And right now, boomers alone sit on $10 trillion of home equity with a T. And so that's just meant to kind of underscore that we're in a very different situation than we were last time when there was kind of a housing shakeup. And it's just not likely that there's going to be any sort of bubble or crash, because this is built on a basic supply and demand issue. We have a very strong demand for homes, especially kind of in the Texas market, and we have not as much supply, and there's not a lot of hope that there will be, any coming.
Awesome. Thank you.
Yep. So I'll move on to the next slide, because I think this is, where the question is like, well, where are we headed? We kind of look where we came from, what's next? Again, this is from NAR. So they kind of give us some historical perspective of 19, 20, and 21. Their forecast for 2022, which they won't officially come out with numbers until early 2023 of how close they were, but they've been generally tracking with this. We can see on that far left column that unit sales in 2022 and then projected in 23 and 24, dip and then start to come back up again. Same with kind of dollar volume. But one thing that's really important to notice, and then I'll hand it back over to you, Chris, is even with all of this, we're still expecting that home prices will continue to kind of see some level of growth. Even next year, when it's expected to be comparatively lower than it's been, it's still growth. So it goes back to that notion of when my clients say, well, I'm going to wait, we have to respectfully, ask them, you want to wait to pay more for the same thing? Because that's all that's going to happen. So I'll let you talk about this, Chris, because home prices and how that works is much more your world versus me and the rates.
Yeah, and so I mean, I think you hit the nail on the head. That center column there that talks about home price with the forecast for 2022 to 2024, doesn't matter that the unit sales are going down, that the dollar volume being sold, meaning if all you added the sales price of all the homes in the country up this year to next year might be less. That doesn't mean the home price is going to be less. It's really just because there's less units being sold, going back to the low inventory. And so we'll still see appreciation in homes. And I think Tyler, Bill, you guys are both Texas. We're seeing a higher growth, I would assume, in 2023 than that 1%. That's national as a whole.
This is national. Yes.
We're going to see that at a higher level. So the appreciation here is probably going to be significantly more than that. And so the home prices are still going to continue to grow and still continue to climb. So that's, like I said, the biggest takeaway is that middle column there, that despite lower inventory, lower homes being sold, and interest rates being higher than they were a couple of years ago, home prices will still continue to increase.
Absolutely. And then I think the last thing I'll add on that is, again, speaking specifically within the context of Texas, most major Texas metropolitan areas, and I can speak most comfortably about North Texas because that's where I reside and that's where the majority of my business is. Because Texas is so business friendly and major corporations keep moving here and individuals move here, there's just a continuous influx to Texas because the opportunity is so good. Again, it's a basic supply and demand issue. Depending on who you talk to, at least in North Texas, there's between 200 and 300 people every day that show up to the region every day. And while not every one of them will buy a house, they have to live somewhere. So the pressure on housing is real and it's intense. And builders, they're building as fast as they can and they're doing the best job they can, but they still can't keep up with it. So if you haven't figured it already, we're trying to kind of communicate that there really isn't going to be much of a forecasted change in the supply demand issue. So if buying a home for someone who's viewing this is a foregone conclusion, we're hoping that the message is received loud and clear that it's probably better to do it as sooner than later because the situation isn't necessarily going to improve anytime soon.
Awesome. So kind of a good summary of where we've been, what we're seeing today. What we see a lot of and hear a lot of as far as media and what people like to talk about right now is the recession. It's kind of the elephant in the room. And it's creating a lot of caution and angst. I think that's why we're seeing a lot of people, maybe I should wait, maybe I should put the pause button on. And for some people, that absolutely may be the case. But generally, as a whole, is there anything or pattern-wise or consistencies we can pull from past recessions to give where we might end up through this recession going in 2023?
Absolutely. I love talking about this because, again, in my job in trying to provide financial peace of mind, so much of it's education and just debunking myths and just putting the real information out there so people can make an informed decision. So I've got some more information on that I want to share. So here we go. So when it comes to mortgage rates and how they react to recessions, I think this is really important that people see this so that they kind of get a sense of where we are. So this is basically the same graph that we saw at the very beginning, kind of the historical trend of where mortgage rates have been. And every one of these kind of shaded areas are when we've had a defined noted recession. All right, so there's some general kind of trends that I want people to kind of take away from this is that when the recession hits, there's oftentimes a bit of a spike, and then it tends to help push rates down. We see this kind of time and again. And so this last recession was relatively short. And by the way, I'm going to put my 2 cents in here. People fear recession as if it's the worst thing ever, and it's not. It is a natural part of our economic cycle. We need it. It's as if you had one of those old school pressure cookers, maybe that your grandma had in the kitchen, and if there was no relief valve, it will blow up and kill everybody. So we need recessions. They serve a vital role. So knowing that they're going to be part of the cycle and that they have a role in the cycle, we can say, okay, let's look back and see what these recessions have done. And as the chart tells us time and again, in general, they push rates down. So one question is, and this, it's always funny when you talk to the economists and the Fed and everybody else when they decide we are or are not in a recession, because it's technically defined as 2 quarters of negative GDP growth. Well, newsflash, we've kind of had that. So whenever the powers that be decide to say that we are in a recession, be that as it may, we will be eager to see, when we kind of see these little spikes up, have we already had that? You know, if we go back, I won't spend much time on this, but I'll go back to this one just to kind of visually show it. Remembering that this is inverted. So as this goes down, this means rates are going up. As this goes up, it means rates are going down. Was this bump up in rates when they kind of briefly touched around 8%? Was that our little peak that we needed to see, that we've seen historically? Who knows? We don't know. But we know that generally speaking, we should expect that there'll be a favorable treatment to mortgage rates in the recession.
I mean, I think that's good news to hear, and it's definitely an interesting way to look at it, where it's not a shot in the dark of doom and gloom, what can happen. It's something that shows historically what we've seen.
Yep, absolutely. And I want to share another slide because I think it's also directly related to it. When we look, and this now goes back a little further. Oops, there we go. This goes back a little further than just that other chart. This one goes back down to the 60s, as you can kind of see below. But every one of these shaded areas are a recession. And then this is the S&P Case-Shiller Index. And so it's a really valuable tool for people in real estate and the financial analysts to kind of see, well, what's the housing market doing? Okay, and so again, as we look at this trend line, we say, okay, in general, we've done well for real estate and home prices as far as that index. We're in recessions. There is a very notable kind of change, and as has been said several times in this presentation, this precipitous decline was because the Great Recession was brought on by a litany of terrible policy decisions, lending decisions, consumer behaviors. I mean, there is no one party that's responsible for, I'm not talking political party, there's no one entity or group of entities that were responsible for the mortgage meltdown and everything. You know, to a large degree, everyone had a hard hand in it. And so, yes, we saw that this one went down, but again, it was a house of cards. And even this most recent recession, you can tell that we did well. So that's really what I want to kind of share, is that history tells us that in general, with the exception of this very notable exception, we should not fear a recession from a real estate standpoint. That's not meant to be dismissive of how a recession can cause, you know, aggravation for people in other areas. But when we're talking about real estate, it generally is favored.
Awesome. Well, I really appreciate that. A big piece of what I'm trying to bring to this, and Tyler, like a takeaway that you can kind of think of, is when we look at all this, it's making an educated decision on what's the right time and the best time for you, instead of acting out of fear. And so, or what else is heard. So the biggest point is to get across that people understand the history and where they are, and are making an educated decision on why they are or they are not participating in the real estate market one way or the other, as opposed to basing it off of an emotional response. It's kind of, we try to use as much data and facts so that it's an informed decision, and you know exactly why or why not you're doing what you're doing.
Yeah, and to that point, Chris, you know, I don't watch the news in general because it just raises my blood pressure. But I happened to be sitting in a restaurant, and there was TVs up, and I didn't even hear it. I was just reading the closed captions, and it was saying that the average homeowner, due to rate increases, will pay $1,200 more per month, and that's not true. That's just not true. And so these kinds of opportunities to educate folks are really important to make sure that the real information gets out there.
what's the saying? I think it was Warren Buffett said something like, be fearful when people are greedy and greedy when people are fearful.
Yep.
And I think that's more the education piece that he's trying to relay in that message than anything else.
Yeah.
Um, because
There's a,
it's
yeah,
it's
there's
a it's a
multiple
point of opportunity for people when each of these happens. And it's, if you're in a position to properly take advantage of the way the market is, um, be as educated as you can so that you can take advantage of it and,
yeah.
maximize what you can do for your worth, your net worth, and your financial goals.
Yeah, yeah. Real estate, when held long enough, will always pay out. It's irrefutable. We can take that to the bank. The other thing about the notion of kind of Warren Buffett quote, a mentor of mine has taught me that don't follow the crowd. They don't know where they're going.
Yeah.
Yep. Get your own information. Make sure you can kind of be informed, and then you'll do better than the crowd, because the crowd typically is wrong.
Well, I appreciate you
Can
being
I
a
throw a question,
resource for us.
Chris?
Yeah. Yeah. Do
Yeah.
you want me to pause recording or do you want me to?
No, it's
Okay.
it's fine. For JMO, I think one of the things that we've seen in the past like year and a half and 2 years is like the sellers have gained all the leverage. And it's been a very competitive market. And whereas typically you're probably used to seeing buyers having, a little bit of leverage, but you've seen in the recent past, people having to go and get a house, sight unseen, skip inspections, those types of things. Um, it's a gradual shift, but do you see that shift occurring where the buyer is beginning to get more leverage? And I just think about it from a larger populace standpoint of, I only buy a house maybe, a few times in my lifetime, what I mean? And you see it kind of every day happening, but at the same time, I don't know everything to look for, and it's, quite a substantial investment. So, the risk of getting kind of like, not a bad asset, but something that, you might be getting yourself into larger expenses down the line with, paint covering up things, or, the HVAC or other systems in the household going out, and not having the ability to kind of vet that ahead of time and kind of build that into your offer package. Those are just some examples, but I guess the base question is just, do you see the leverage shifting back so that it's kind of like an amicable relationship negotiation in order to complete the transaction?
Yeah, I do, and that's one of the main thrusts of what we try and share with our clients right now. But that is a limited time offer. When these rates, as we expect, come back down, again, this is the crowd mentality. Everyone that kind of sat on the sidelines, they're going to start to come back. And while we don't anticipate it that will be as rough as it was when people had to bid 70, 80, $100,000 over for just kind of a relatively standard home, and offer to do insane things to try and curry that the favor of the seller. Right now, because rates caused a pause in the market, this is a really good time to get involved, because to your point, there's going to be more leverage that a buyer has right now than in the future when rates go back down and everyone comes back in. So at least some of those things that you mentioned, like, gee, I'd sure like to make sure that they cover those repairs. I'd sure like to see if they're willing to meet me on these terms. They're going to be way more amenable to that than they were, and what we expect they're going to be. So that is one of the morals of the story, is get involved. And I will offer this up, and I tell every one of my clients this, and it may sound kind of hokey or hippy dippy, but I've done this for 20 years, and I have literally had thousands of conversations with clients, and at this point helped thousands of people across the finish line. I have never seen one time where it didn't work out like it was supposed to, when you have a talented, competent agent. It's extraordinarily difficult for the process to not root out all the things that need to be brought to the surface, so that as a consumer, you can make an informed decision and say, I don't want this one, move on to the next one. But bringing it full circle, you have more leverage now to have those conversations than you did before, and what we expect you'll be able to.
Fair enough. Yeah. Thank you.
Bill, I'll add two quick things. One's kind of reiterating, and one I'm not going to get too far in depth because it's almost another topic. But you touched upon first, from my standpoint with the buyers I've had, it used to be send in 5 offers Saturday afternoon for 5 properties we saw, with hopes that one of them gets accepted. And buyer pay for everything. Buyer's not going to ask for anything. Short option period. Everything that you discussed. To where now I've seen buyers getting $10,000 in seller concessions for repairs for, hey, there's this kind of plumbing damage and the HVAC's not servicing properly, so we'd like you to service the HVAC. So we're seeing a leverage level with buyers right now that is a relief, because buyers are able to feel comfortable with the home that they purchased. Not that they didn't beforehand, but they can have that extra assurance of like, wow, they feel like they won too, not like we had to do something.
Yeah, it was
Um,
higher stakes.
and the second point you kind of touched on about like, with selling your house or touching things up, or what you do from the seller's standpoint. It's an interesting time because if it was one of those times you were thinking about moving, the great thing about the housing market, Jerrett touched upon it, it's going to go up at some point. So just don't sell in a down market if you don't have to. So it's an easy solution if you don't need to sell in the next year or whatever, and the market's not looking like it's ideal for sellers. Shoot, you can potentially buy a new property because it's advantageous for a buyer, get a renter in for that first year, and then after that first year, if the market's better, then you turn around and sell. So there are options for sellers too that are looking to kind of move from one step to the next, where they're like, but I don't want to sell necessarily in this market. And still, we had the appreciation over the last couple of years. So even the sellers that it's not as ideal, they still have a ton of appreciation from the last couple of years, if not longer, depending on how long they owned it. That added with, you can potentially wait for a better seller's market for the sell side.
Well said.
Yeah, it's ebbs and flows for sure. That's, the knowledge is appreciated. It's good to know that there is some leverage being transferred back as well. It's like, hey, my interest rate goes up, in return, I can get maybe a little bit more of a discussion during the time of sale kind of thing. And then, hey, refinance later down the road when money becomes free again.
Yep,
Yeah.
exactly. That is the beauty of it, is that you get, it's both and thinking, both get in the house, start establishing that wealth now, and we're keeping an eye on the opportunity to lower the rate.
Awesome. Well, I
Outstanding.
appreciate
So much.
Thank you, Bill.
I'm going to stop the recording here.